Yeah, and thanks for thanks for folks that are carving out some time here. This should be fun. Yeah, I've been studying the venture space for a number of years. I landed on 3000 Sandhill Road in 1990, joined a multifamily office, and the first portfolio I was handed to manage was Larry Cincini's personal money. And then Pierre Lamond from Sequoia and Sven Simonson, as my boss and predecessor, was longtime Bay Area family and was sort of the go-to boutique investment firm in the 70s and really very much so in the 80s. And the bank in Liechtenstein came calling, bought his firm in 1988, and I joined it in 90. So I just been studying this space from the front row seat serendipitously by joining that firm in 1990 before the internet took off. So we have been assimilating a lot of research in the venture model, certainly from the lens of a money manager. We did our own securities analysis and stock picking, and there was a lot of rigor to that and a lot of process orientation. And even though we picked individual stocks, we didn't view ourselves as stock pickers, very much a process orientation to hopefully deliver repeatable alpha, which we were able to do for a couple of decades. And so that's really the lens that a lot of this research has been assimilated in viewing the venture industry, both from the inside and then certainly as an observer the last decade. And we've launched a company to implement some of this research. And so I've been assembling sort of what I call fellow travelers in folks that have viewed the venture industry through a lens of I'll say, investment rigor and objectivity. First one of our guests and a key part of that lens and that view is Mel Carter. Mel, why don't you introduce yourself?
Yeah. Good morning, everyone. And again, thanks for putting this together. This is fantastic. Mel Carter with Grosvenor Capital in the private equity group. So Grosvenor bought the Credit Suisse Customized Fund Investment Group years ago, and I've been doing this for a little over 17 years. Really focused on primaries, venture and growth being my primary focus. I've been involved in investing probably 100 different venture funds over the years, and currently on the board of 40 plus venture firms.
Thank you. Mr. Rupert.
I used to work at T. Rowe Price, retired, was a venture partner then with Greenspring Associates. The founder of Greenspring worked for me at T. Rowe Price. That was sold to Stepstone last year. It was a $17 billion asset management firm. I'm on the board of Antler, which is a very rapidly growing asset management firm globally that focuses on venture capital. I think they're probably the largest proprietary company builder. And I'm a very, very active investor in funds and directly in deals in about 25 different countries around the globe.
Lovely. Mr. Goldman.
Yeah, hi everyone. Where do I start? I have been running, although I sort of transitioned this past year, running for a number of years, the family office for Eric Schmidt, multi-billion, very big family office actually. But I really got my chops, so to speak, doing CFO work, CFO for companies like Yahoo, Fortinet, which we helped take public, Siebel, Sybase, a number of other companies involved with 3 companies going public. I've been on probably well over 40 boards now, if you count all my public boards. I'm on 4 public boards now, actually 4 private boards and 3 nonprofit boards. As Todd said, I'm a very active investor in both venture funds, private equity funds, in one-off deals, and involved in a number of family office conferences and events. And so I keep myself relatively busy. And I like to do, honestly, it's funny, I like to do active sports. So I do kiteboarding, skiing, golf. Actually, golf's not that active. And so I keep pretty busy. And actually just got a text as I was getting ready. My son says we're going to Montana to ski last week, and he says there's a big storm coming. Maybe we should stay an extra few days. So we'll see what I do. And then you got to do what you got to do in life.
Well, now you have to tell us your handicap.
It's really high. It's over 20. I'll just say it that way. I'm a better kiteboarder than I am golfer.
How about pickleball, Ken?
No, it's funny. The reason is I don't have good hand-eye coordination. So I'm better at sports like skiing and water sports where you don't need, you can sort of compensate for lack of coordination with just, stress. strength and, compensating one for another.
Hey, Ken, this is Peter. I'll just note I was in Park City last week and plenty of snow and great skiing out there. So recommend that too.
Yeah, well, thank you. Let me know. I'm actually going to be in Deer Valley for early February with Morgan Stanley and folks. So I'm going to be skiing Deer Valley in early February. So I look forward to that.
Yeah, it was awesome.
Well, yeah, no, skiing, for those in this call, skiing in the West, you just look at the weather and the rain and snow and everything else. It's just crazy. It's great, actually.
It's
So
awesome.
Well, I think you can all tell we all aspire to be Todd and or Ken, for crying out loud.
But,
It's-
it's what happens when you've been around for a long time.
and last but definitely not least, Collier, why don't you introduce yourself?
Thank you. Yeah, and appreciate the opportunity. Looking forward to the continued discussion. I represent a single family office. We have investments across, like most large multi-billion-dollar family offices, across every asset class. Our main two holdings are venture and private equity. Venture and real estate. And I run all the privates for us. So very active on the fund side, very active on the direct side. Looking forward to the conversation.
Yeah, thank you. Well, Mark, were you going to give me? There we go. Thank you. You're right.
Why don't you take it over? I'll give you, so you don't have to say next slide.
All righty. How do I do that? This is where we didn't train ahead of time.
Or I'll take it back.
You go ahead. Just click to the next one.
All right. Give me a second. Well, you start talking. I'll catch up.
And so again, this is not a long presentation. This is meant to be fairly interactive, but somewhat provocative at the same time, because there is a gap in awareness of the changes that are taking place in the venture model. There's been a lot of thinking, a lot of academic studies for a number of years, and it was really almost pocket work being done going back 10, 15 years. But there's a growing chorus of academics and others that have been doing some real interesting work on almost rethinking. Okay, I want you to go to the next slide. Rethinking the venture model itself. And again, this evolutionary view is using some of the tools of the public markets. So a lot of this sort of narrative is going to come and be framed within the context of investment practices that have been long since recognized in the public markets. But one of the things that people don't realize was captured in Tom Nicholas's book, VC in American History, which is sort of the update on the history book on the venture industry itself. It's a wonderful book. And on page 311, he literally says it's ironic that the venture industry that funds innovation largely hasn't innovated since the first fund was launched in 1959, following the Small Business Investment Act in 1958. The very first venture fund was an SBIC, but the second one was a partnership, and that's largely been the model ever since. And so that's something that is finally getting some attention and some conversation. Is the industry that funds innovation themselves hasn't innovated. Now, there's been, again, some reports come out, and there is at the bottom of this links to a number of research pieces and white papers and the like. So for folks that want the deck, we can provide it. I think it's been part of the materials Mark sent out. But Sequoia announced October of 21 that they were changing their business model. And in their announcement, they spoke to this very point as well, and this is their quote, as chips shrank in size and software migrated to the cloud, the venture industry is operating on the business equivalent of floppy disks. And it was a pretty poignant and pretty poignant way to draw a proper light to the very changes that have taken place elsewhere, except for the industry that's funded some of those changes. And so that's really the context of what's happening. Now, the headlines, we've all been seeing a lot of these headlines about what's going on. Certainly FTX is the current one, but there's a lot of others on what you could generously call a misallocation of risk capital, because the process of deploying that capital was caught up in what can, again, generously be labeled bubble mentality. Gosh, what were we thinking? And those of us that have been around a while, saw this behavior repeat itself in the 90s, obviously with the .com, but you also saw it in the real estate and financialization process that led to the financial crash in 08, 09. So that sort of behavior, that tulip bulb mania, that sort of, we saw it with the meme stocks recently and NFTs and the like. So that's part of the human condition. And the model itself is always going to be subject to that. But this narrative and a lot of the research is about how can we instill a little bit more rigor in the process so you can guard against some of those behaviors. And most importantly, we can deploy capital with greater scale and efficacy to support more entrepreneurship around the country. And we don't have such a concentrated behavior either geographically or money concentrated in a few of the hands of firms that tend to dictate the narrative. So one of the big questions, and Mel, again, I'd love to have you inject in some of your historical view on some of those topics that I just touched on. If you've got anything to add or would like to inject some thoughts.
Yeah, no, while we're here today, and I've known Joe for a number of years now, and the conversation is what can be done different, what's changed, what hasn't. And I'm looking at things from a institutional LP perspective. If I'm representing, whomever, and want to invest in venture, well, what's the best way of doing it? Well, you've got to have enough volume or enough size in the program itself to be able to diversify across, again, whether it's early stage or whether it's healthcare, whether it's IT, whether it's whatever you're focused on. Use the expression stock picker. Well, if you don't have enough invested and enough to invest in the venture space, you're undertaking an enormous risk. Hey, it may work out great. You may have picked right, or the market changes and you're left with a lot of zeros on your sheet. So for me, what is interested, and again, what Joe and I have talked about, it's what can be changed, what can be morphed so that you can really look at at venture firms differently. If you can look at how they invest in order to put together a real institutional portfolio with smaller bite sizes. So
yeah,
that's kind of where I come from.
And folks, like I said, I want to, in a spirit of brevity, I'm going to try to move through these things, but you guys raise your hand or inject anywhere along the way. I don't like canned presentations. So, but one of the questions I've gotten as I've been assimilating a lot of this research and having conversations is why hasn't the model changed, as Tom Nicholas pointed out in his book? And again, the explanation has always been, well, the venture industry has always been an apprenticeship model. You start with NEA or some of the old guard firms and you cut your teeth for 10 years and you learn the ropes from the inside. And then you go off and oftentimes spin out if you weren't made partner soon enough, or you've got an established relationship with enough LPs or potential LPs to maybe go off on your own. And that was a fine model when it was a very small industry, somewhat of a cottage industry, largely in a couple of locations. And the volume of entrepreneurial activity was also fairly concentrated and the numbers were fairly small. It was a very much apprenticeship guild model. And it was very much in investment terms, a real niche satellite strategy, and it could add some juice and some beta to the portfolio. And it was largely viewed through a proper lens because the industry was fairly nascent in its evolution, as was innovation or startups. But even though the NVCA was launched in 1973 or 74, it's still largely been a lobbying organization versus a professional standards and best practices organization. And if you look at the history and look at their websites and look at the content they put out, it was largely about representing the venture participants, their membership in Washington. And so it never did establish professional standards. There's never been established body of knowledge on what to study to actually launch in and be a proper fiduciary of other people's money. In fact, the opposite has been true. When we had the 90s and the .com, anybody could launch a fund and throw some money at the wall and see what stuck during that bubble period of time. Now, the smart investors, there's lots of good VCs out there. Don't get me wrong. There's folks that have had an apprenticeship and they've got wonderful internal training and systems and back office structures and real disciplines in how they're deploying other folks' capital. And they've, in many cases, been deploying a lot of some of the research that's been coming out as of late. They've been deploying that instinctively and intuitively because they're experienced investors. But it's still been largely an access class. Who does understand how to deploy capital in this risky asset class? And folks like Mel has been studying these folks forever, and Todd and Ken have been participating with some of these folks for decades. But it's largely been an access class versus an asset class, where you could actually view the index of the returns as a representative example of what you might expect as an investor, where it's like we do in the ETFs or mutual fund world, where institutional investors deploy capital in the public markets. So next slide. So where are things taking place? There's a wonderful report that came out. It's in the sort of the bibliography at the bottom of this. But a Deepak in Singapore, whether it was a sovereign wealth fund or family office, I don't recall. They hired Clayton Christensen's consulting firm, Innosight, to study the venture industry, classic consultant analysis. And they wrote a report that came out in late 20 or early 21 called The Future of Venture Capital. And they lay out a lot of these things. PitchBook's report that came out and Ernst & Young's, both that came out in January of 2021, talked about some of these very things we're talking about here in listing. And that is just part and parcel, greater use of data. The importance of using data to make investment decisions shouldn't be self-evident or shouldn't be a revolutionary concept, but in the venture asset class, it really is. And so some of the innovative funds that have been launched are using very much hedge fund-like use of anecdotal data to try and get an information advantage. Because the venture industry itself and startups themselves don't have to report like public companies are required to do, that allow folks that can access now that real standardized data to make informed investment decisions and build and manage portfolios off of data. The venture industry has been opaque, partly due to the lack of regulation over startup reporting, but also partly due to, as we pointed out earlier, really the lack of real formal training on the part of the industry to understand what data to source to start taking a more data-driven approach until late. So some of these changes are starting to take place. We're starting to see evidence of some of that. We've seen the big investment platforms come out and launch 40X structures around late-stage venture, building fund-to-funds in a late-stage model. We're starting to see this evergreen funds, which is a venture capital industry's way of talking a 40X mutual fund, just an open-ended strategy where it's not closed in its time period or the money that can be deployed. So we're starting to see this evolutionary movement towards some of this research that's been coming out, and it's starting to look more like an asset class modeled after a lot of the best practices for public market investing. I want to put a pin right there real quick. Again, I know we're covering a lot of topics fairly high level. Todd or Ken or Coyle, is there thoughts you want to have on some of the materials we've talked on?
Well, one of the things that you're talking about is increased diversification. And if you take a look at the difference between the public and private markets, if you take a look over long time periods, the dispersion between the upper quartile and the lower quartile of, say, a small cap equity manager, a large cap equity manager, is quite narrow over a 15 to 20 year time period. But over that same time period, if you look at the venture industry, there's enormous distribution of returns between the top quartile and the bottom quartile. And the bottom quartile is usually losing money. And why is that? Why is that? The venture capital is a lot of strikeouts and a couple of home runs. It's a power law driven asset class. And so if you've got a small number of companies in a portfolio, the likelihood of not generating good returns is high. If you happen to get those few power law players in there, you can have huge returns. And so hence the disparity between top quartile and bottom quartile is high. If you want to try and take the venture industry and treat it more like the public markets, you want to reduce the spread between the upper quartile and the lower quartile, so you have more predictability in your return stream. And I happen to be on the board of a company called Antler, which is a global company and a large company builder. And they have 15 different pre-seed funds around the globe. And now they've created a fund that invests, it's a fund of funds basically, at no fee, no carry, that invests in those underlying portfolios. So they're creating a portfolio of not 20 companies or 50 companies, but 1,500 companies. And when you run Monte Carlo simulations, which they've done about 6,000 Monte Carlo simulations, you dramatically truncate the spread between upper quartile and lower quartile. And actually you increase the returns because you're getting more of those power law upper quartile performers into the portfolio. So there is a lot to be said for increasing diversification in venture portfolios.
Todd, well spoken. Again, it's a simple concept. Diversification mitigates risk and mitigates downside, so you can capture the corresponding upside of the asset class. That's not a Herculean concept to embrace from an investment perspective, but it's one that's relatively new for the venture asset class to embrace. And so, well stated, and to Antler's credit. Ken, any thoughts?
Yeah, I do. I think the reality is it's funny. I see a lot of proposals for venture funds. Everyone comes to me. I get so many people coming to me, both because I know a lot of people and also because of my relationship with Hillspire. It's funny. Everyone says they're top. It's funny. It's like everyone's above average. Everyone says they're a top decile, top quartile fund. It's unbelievable. You think the whole world is above. You think everyone is above average and smarts. It's
only when they're raising. That's it.
Yes, yeah. So I would say I take a lot of this with a grain of salt. Honestly, I think the challenge I see in venture, and I have a discussion with a lot of folks, is particularly in early stage, is how long it takes to get your money, just get your capital back, never mind a return on your capital. I mean, I see a lot of great marks. But you can't eat IRR. The only thing you can eat is DPI. They said over and over again. I think I do like a lot of the established funds. I do worry about some of these funds that I think have gotten too smart for their own britches, so to speak. Like Sequoia goes to this continuation approach, but they could have, they and others missed selling some of their best opportunities last year, and now they're stuck with investments that are 60, 70, 80%, 90% below where they could have distributed. So I think there's an issue of when do you distribute, how do you distribute when you get liquid stocks. I recall in the early days, the idea was when the Googles and Microsofts went out public, most of the Amazon, most of the appreciation occurred after they went public, but with companies staying private longer, I don't know that that's is still the case. So I'm happy to go. I don't want to say too many things, but I'm happy to go wherever questions people have.
That's very insightful, Ken. Carla, any thoughts?
I mean, we're covering like 25 different topics here. I'm happy to kind of go into more detail or thoughts around any specific, but I feel like all three comments between yours, Ken's, and Todd's we must have covered 15 different topics. So, I mean, we could talk about the liquidity issue. We could talk about the lockup issue. We could talk about the diligence issue. We could talk about the lack of standardization, lack of reporting. I don't know what we want to talk about. I mean, the one thing that keeps coming up for me, and we kind of mentioned it on the call yesterday, is and Mel kind of touched on it, which is he's coming at it from a certain perspective. So I think that whatever perspective you're coming at, a VC can mean a lot of different things, and therefore the outcome can mean a lot of different things, and that's just a very high general comment around. I don't know where exactly we want to take this conversation. The one other thing that I think, and I haven't finished reading your report that you sent over, and I hopefully will today, is I think that stage has a huge impact on this conversation. So on an overall basis, majority of what we're talking about, I think, applies more to seed than most other stages. And I think on a general basis, most of this makes sense. But I also think that there's a vertical focus towards the overall portfolio construction that does change the conversation. But once again, like that means now we're going into details. So I don't know where we want to take this, but there's a lot to talk about every single aspect of this.
Well, that's right. And I think it was Todd that was talking about, touched on one of the topics here on the slide, is diversification is a fundamental, was it Howard Marks or who was it that said it's the only free lunch in investing is diversification. You literally can manage risk just through basic diversification. And yet the 30 company venture portfolio is not an optimized diversified portfolio unless you're at the B round or beyond. And the research that's out there from numerous sources certainly confirms that. And that's just how you manage what financial professors would call non-systematic risk or transaction risk. But the other risk to manage is systematic risk through staged capital deployment over multiple rounds. To your point, Kalya, is absolutely round is relevant. And the way you deploy capital over multiple rounds is critical to manage systematic risk, which also, to Ken's point, addresses this issue of how long is the money tied up before I get some return on capital. And there's some wonderful optimization models that have been out there, specifically called the Kelly criterion, that is actually comes from the poker industry, but also what's called multi-arm bandit. It's a game theoretical construct to optimize on return on your bets you're placing when you're able to place multiple bets. Where your early bets, the seed round, is where you're starting to place your early bets to start gathering information so you can make your larger bets later, very similar to the Kelly criterion, once you start getting an information advantage. And that's really an optimized model from a theoretical construct that was supported by rigorous analysis. And it very much addresses some of the things both Ken and you, Kalya, talked about, which is how long is my money be tied up before I get an actual return on cash return? And what's the proper diversification at what round, to your point? So
can I just, as a follow-up, I'm just curious. So I think that for me, I get it pitched by a lot of fund managers that think that they're doing something different. And let's assume that they are. And they like to play the concentration versus diversification play. So basically, what I heard you say, if this is right, is beyond the B, play the concentration game. Up until then, it's probably not the best game. So maybe I could just pose the question to the panel, which is, how do you guys think about concentration versus diversification as it relates to fund investing on an overall venture portfolio?
I'd say the more diversification at the earlier stage, the better.
Yeah,
and then you can concentrate in your winners over time. And also, diversification just doesn't mean number of companies that you're investing in. It means diversifying by geography, diversifying by founder type, diversifying by industry. There's a lot. I think a lot of people just don't see it. There's an incredible amount of opportunity outside of the United States, and valuations are far lower at that early stage. So a widely diversified, globally diversified, industry diversified, founder diversified portfolio, I think, sets you up nicely to then follow on into those winners in later stages.
That's exactly right, Todd. I mean, that's exactly right. I mean, if you just basic theory of diversification is you want to diversify across uncorrelated assets. Because if you have a lot of seed stage NFT providers, well, that's not very, even if it's 50 of them, it's still not very diversified, right? They're all going to move in the same direction, largely based on the externalities of that marketplace. So,
Joe, Mark here. I just want to keep it with the community, and a few hands have gone up, and there's some questions in the chat you guys might want to check out. Rob, you want to lob a question in?
Hey, thanks, Mark. Great job all around. Good to see a number of you all. Just on that last point on the 361 has developed a nice international community. I think Ken and Todd made mention a little bit of some of the international interest. Could you speak a little bit about what you're seeing as far as either LPs coming from overseas, as well as strategies that are more international driven? That might be a Grover question, or Ken, or so.
Yeah. Mel, anything?
Yeah, well, I mean, we have not invested in any. I say we have limited exposure to non-U.S. venture. I will say I have seen in the last before COVID, in the COVID period. So, pardon me, the dates all run together. But there are a number of early stage venture firms based in the Middle East, both Israel and Dubai and elsewhere, that are really trying to focus in on the undercapitalized, underserved areas. When looking at small, almost micro investments in Mumbai to Nairobi to again parts of the Middle East, and they're seeing great people with great ideas and a real lack of burden on having, seen what others have done before. So they're real problem solvers. And there are a number of these firms that have just absolutely performed very well. And I'll refer back to Antler. I've known that team for a while, and they've done a really good job being able to find these opportunities worldwide. So I think what we'll see, just like everything, what's how many $1 billion scooter companies does the U.S. need? We've got way too many of those.
Probably zero. Probably
we're
zero.
talking about people around the world that are really problem solving, and so I think we'll see a shift. I think we'll see more capital going to those startups, which is good for everybody. It's good for humanity, and there's money to be made in good, smart people. How do you monitor the risk? How do you diversify, and how do you access it?
Yeah.
So Yad has a couple comments. One is, if I go around the world, China used to be a very good hot spot. Now it's very, it may be a thawing, but it's certainly been questionable for the last couple of years. So I think in the rest of Asia, it's selectively relatively small funds that I see that I get involved in. I think India is getting. It's been going to get there for a long time. I think it's getting better. Again, relatively small funds, but to me makes sense. Middle East, you were commenting. I'm involved with Mubaba. I can never pronounce the name. Yeah, they are getting very active in venture, and others like them in the Middle East, was just mentioned. Israel continues to be a hotbed, and then Europe. I find it very selective. I'm not sure how good Europe is overall. Those would be my geographic comments. And Latin America has always been a continent it's always going to be a budding continent. I hear that every year.
The one area that you didn't mention, Ken, is Africa. And I'm invested all over the globe, but there are some tremendous opportunities across Africa in a lot of different industries, and the valuations are dirt cheap.
I used to hear that, I'm not going to Davos this year, but I've gone to Davos many times, and I would listen to them talk. At some point, you're right, Todd, it's going to make sense. But I have to tell you, sometimes to me, it's deja vu. I've gone there for a number of years, and I would hear the same story literally every year. So you're right, it will happen, but it's been a long time coming.
I wouldn't concentrate a portfolio in Africa, but as a diversified play.
There you go.
Yep.
I know we're bumping into the Q&A. Mark, why don't you, is that the next slide? Is Q&A?
Yeah.
Yeah, there we go. And the last slide, again, just touch on it, Mark, real quick so folks can see what's there. There's a number of, reference points too that I touched on earlier. There's some wonderful pieces out there that have come at the venture industry and dissected some of the issues that need changing and need fixing. But at the end of the day, it comes down to, can we support innovation, real innovation, not Me Too follow-on scooter or food delivery companies or fill in the blank, but real meaningful and important innovation in a more structurally efficient and efficacious way. And that's really what this research is about, from a capital deployment, and also from so you can lower the cost of capital for the entrepreneurs that are actually interested in pursuing meaningful innovation and don't have in-network contacts to source the capital they need and some of the other things they need to try and take the risk to build real innovation. With that, this is the first of three. As Collier was talking about, there's a lot of granular details, which we will be getting in the weeds in follow-on conversations. So this was really just to introduce the concept and frame the need for just exploring, examining, and rethinking how we're supporting and funding real innovation.
Joe, just one other thing before we continue. I think at some point we should have the conversation around generalist versus sector specialist. I think that anybody listening to this conversation would, and they think the other, would probably argue that a specialist approach might be the way to go. So I think that would be an interesting conversation to have down the line.
Oh,
if you're invested globally, and you're actively sharing information, you can pick an asset class, pick an industry, fintech. There are a lot of things that a fintech entrepreneur in Africa could learn from a fintech entrepreneur in some other part of the country or the world, and vice versa. So if you've got the tools and the mindset to be able to share that information, you can be a generalist, but have specific knowledge skills across a lot of different industries if you're invested in those industries on a global basis.
Without a doubt. And again, the entrepreneurs need that sort of specialist insight, without a doubt. The one risk that we will touch on in a subsequent discussion is, we talked about systematic risk, which is timing risk, and that's managed through staged capital deployment. We talked about non-systematic risk or transaction risk, and that's through diversification. The third risk is a growing body of conversation called decision process risk. And that comes down to Danny Kahneman's work, the behavioral economics or behavioral finance. Moneyball is the sort of poster child for the issues around how to manage the decision process risk through more objective sourcing of data and decision models versus getting locked in on something where you feel like you can be an expert. So that debate about generalist versus specialist is going to be fun when we start injecting that behavioral economics and behavioral finance work around optimize decision models and manage that decision process risk, because that's what a lot of the headlines we see today ultimately are fueled by that the decision model itself was suboptimal because people got too locked in on something, whether it was, you go back to Uber's funding rounds, WeWork, FTX, some of these big headlines really do bring to relief that issue around the need for more objectivity, more data, less of that personal decision model. And that's, it's a slippery slope of defining yourself an expert and then getting too anchored in that belief system that could lead to some bad outcomes. So it's always a balancing act, obviously. Any other, I know there was a lot of questions. I couldn't think and talk and read the questions in the chat box all at the same time.
Let me just make a couple comments about the implications of falling valuations, which we've experienced this last year and this year. I think, just kind of forward looking, I think mega rounds are going to dry up. Portfolio companies are shifting away from growth at all costs and focusing a lot more on extending runway. There's an increased focus on path to profitability. I think the secondary market is going to be very attractive. And if you look historically, investments, and this actually works quite well over time, starting a company and investing in companies in those vintage years that are right after a recessionary period have turned out to be quite attractive. So I would argue that putting money into the ground early stage over the next couple of years is going to end up to be quite attractive.
Todd, I think you just summarized buy low, sell high, right? And yet we saw a lot of capital allocated when prices were really high. It's just these lessons learned that need to be learned by a new crop of investors is the ultimate goal is buy low and sell high, whether it's your own money, obviously, or if you're in a fiduciary position. Mark, were you monitoring the questions, or were there questions you wanted to have this group?
One question was, we talked about this yesterday. How do you define VC?
It's an interesting question. Well, that's a really worthy exercise if we're thinking in terms of real structural definitions, because VC has looked a lot like private equity, a transactional approach, right? To focus on the individual company and then what value you might be able to add. Private equity and as a broad label is about using a lot of financial leverage and then thinking they can do some things to improve the underlying operating company, but they have a lot more financial data to work from to apply their magic to improve those operations. But at its core, it's private equity and venture capital have a lot of overlap in the mindset of it being historically more of a transactional approach, a deal by deal approach. That's my view.
There's an army of entrepreneurs around the world who have a desire to innovate and grow and change the world. And venture capitalists are the ones that are risking their assets to back them. That's the quick decision, quick definition.
Any others?
They're company builders.
Hey, Joe.
Who is it?
Hi, Joe. It's Safa.
Safa. Hi, Safa.
Hey, this is a very interesting question, and especially for me. I'm one of those managers, Ken, who goes around and says that we are outperforming the top 1%. In this case, of course, you will like our number because our DPI is 20% compared to 1% for our vintage. But my question really has to do with the way that a manager like me can do diversification and still be able to have those home runs that you talked about. Venture business is different from public equities and other liquid assets because access is not universal. And what I've learned over the past 15 years, 20 years I've been in Silicon Valley is how to build that access so we can get the right diversification. Instead of 30 companies, I can have 100 companies on a portfolio. But if those 100 companies are the so-so companies, and I get probably about 20 inbound emails and LinkedIn requests to review the pitch, that's not going to do me any good, nor will it do any good for my LPs. So I need the access to the best people who just left Google, Amazon, or are being funded by others like me. So I'm just wondering, how do you model that in? Maybe that's part of your third risk that you talked about, the selection process. But to me, that is the key distinction of the venture model, and what I believe is what will make venture funds succeed or not.
Yeah, I think you bring a real important point about the structural difficulties of building a properly architected portfolio if you wanted to follow all this research that's out there, right? Because this is theoretical research. This has not been deployed to my knowledge where there's been proper diversification and proper stage capital deployment across multiple rounds to manage those risks properly based on data versus personal perception, sort of that decision process risk management. So there's not been a fund managed to this. Why not? What are the structural limitations? The key thing, and it really does go back, I think, to the public markets. You know, if you were a publicly traded company in the teens or 20s, 100 years ago, you didn't have to report in a standardized way. There was no SEC to enforce GAAP accounting requirements and these sorts of things until the crash of 29 and the 33 Act established the first standardized reporting for publicly traded companies, and the SEC was formed to enforce it. And if you look at the 33 Act language, it literally says in an act of risk management, they established these. So to your point, it's damn difficult to build, architect and source and architect and manage a proper venture strategy if you aspire to all this research without good reporting coming from the individual companies themselves. And that requires a lot of the in-person interactions that take place and start opening the doors for, again, the variabilities that come from that version, that in-person interaction.
A question from Zarin.
Yes, another question.
Yes, a quick question. I was reading in Matt Levin's column, actually, that most of the mutual funds, when there is a big volatility, of course, it's traded day to day. You can see how the prices go down. But the private investments, private equity, venture capital don't have to do that. But they have been pressured to do it, and they do, write-downs as well, like the big five, it was mentioned. And so the question is, well, what do you think about this, having managed, Joe, also like liquid assets as well? And also, how would that affect the risk management? Because, banks also lend against client portfolios that have allocation to alternatives. And, banks also need to adjust their Lombard lending, maybe ratios.
That's a really profound question. There's lots of layers to that, Zoran. And having managed money in the public markets and clients' assets in the private markets, it ultimately, again, has been, you do it at the portfolio level. Again, think of an individual family, right? You don't have a lot locked up in those liquid assets. So it's not your collateral for loans. It's not, it is your satellite strategy that's to add beta and add some icing on the return cake, if you will. That has been so you manage the illiquid nature of it through how much you actually deployed in the asset class itself. If you're a manager of a fund, you can manage a lot of that volatility of pricing and reflected performance through just, again, the staged capital deployment. Don't spend all your money too soon. So you can manage systematic risk, timing risk, because you can't predict the future, but you can manage risk as you move into the future in deploying capital in an illiquid asset class, and that's through staged capital deployment.
Joe, yesterday Ken was commenting on how he saw the fall and how the write-downs are we're going to see the marks coming through this year. Is that fair, Ken? Slowly?
Yeah, I mean, it's interesting. When I ask, I would say when I look at the secondary market, when I see the marks, it's funny, the secondary market, the marks are all the way down to 50 to 70% of what I show for net asset values. So it tells me, at least the secondary guys don't perceive the current marks as realistic, which means it is probably somewhere in between, because obviously secondary guys want to make a lot of money.
Yeah.
So
there's blood in the water.
so there is a arbitrage going on, but my sense is, if you took a basket, the current marks in both private equity and venture may be too high by about 20%, if I would, across almost everything.
Yeah, and I'll chime in on that. I think that's a fair take. That's one of the things, being on the boards and underwriting is asset valuation. The managers are, to me, you'd want to get all the bad news out as soon as you could. But there's some investors that person that's the investor gets paid on IRR, so that maybe they don't want all the bad news out there. So there's some conflicts, but in general, I think there's still some downside into where things are right now.
Okay.
Any other questions?
Discount secondary pricing discounts to NAV, and that doesn't necessarily mean that NAV is attractive. It went from 88% at the end of 2021. It's now at 65%, and I think to Ken's point, it can go further down.
Richard, do you have a question?
Hi, thanks to everybody. I've had a really good time listening to this conversation. My neck hurts from nodding.
That's a good one.
My business is Capital Pilot. We built a rating system for startups to try and create some of this data against which you can invest. But my key question here is, and the ongoing question in our business is, what's the incentive for the industry to change? Because isn't everybody fat, dumb, and happy? Isn't everybody perfectly happy? Model as it exists today. So we see all these risks that you've identified, Joe, but what's the incentive to change?
Well, that's a profound question, and it's sort of again, I'm a student of history and certainly financial history, and if you look at the narrative around when index funds started surfacing, people realize they started surfacing roughly in 1970. And of course, there was the same hue and cry from the active management industry about, you've got to know the companies, you've got to really get into their earnings per share calculations. And that same narrative was going on back then. And so you can see this play out, and it looks exactly the same in the venture asset class. I don't think it'll take 20, 30, 40 years for this change to take place. I really don't, because there is, with technology, it's allowed for movement in bringing some innovative venture models. It's already happening. But at the end of the day, it's going to have to come from the money. That's why Mel's opinion is so important, because when you're a serious allocator, an institutional allocator, ultimately the money has to have an expectation from where they're deploying that capital. And conversely, investors, the VCs that do launch funds, have to have set higher expectations from the startups themselves. You want this money, you need to report better. So that money's got to dictate the change to ultimately make sure that if we need venture construction where there's more rigorous and thorough risk management, that's got to come from the LP side. If we need better reporting from startups, that's got to come from the investor side, whether it's a venture fund or family office or angel groups or whoever else. So the money has to dictate the expectations, and that just depends on where they lie in that food chain.
Yeah, and I'll add that just a little bit. Just, again, what's going to dictate change? Well, it's certainly from this perspective, but I'm already seeing some funds embrace this to a certain degree. So it's the advent of the whole scout investing embedded within a fund. 10 years ago, rarely saw that. Now there's a handful of second generation type funds that realize, hey, my returns really go up if I have these 40 different scout investments. And then I get to follow on within that same fund, the 4, 5, 6 that really take off. So just like everybody, you want to invest in venture managers that are interested in the carry, not interested in the management fee. And as more people realize what could be and are brave enough to do little things a little bit different, I think the return profile will accelerate this move toward greater diversification and then a much more serious follow-on to what those investments are. And again, not done in opportunity funds, but done within the construct of the fund itself.
I'll make a comment here. There were more than 2,000 first-time funds started over the last decade. 300 of them in 2021, and that's dropped off a cliff in 2022. But the cost of starting a fund is not that expensive.
Mm-hmm.
And most of these funds are going to be a small number of people running them. In many cases, a one-person fund. You can't. It's humanly impossible to have a very, very, very broadly diversified portfolio with a small team. So if diversification is a concept here that we talked about earlier is going to narrow the spread between upper and lower quartile, so actually improving the beta, if you will, of the venture capital asset class, you need a very, very large platform, and it needs to be global. And there are not a lot of firms that are out there that are able to do that. Most of them are small.
I think the industry itself, again, is going through its own evolution, Todd. You're absolutely right. I think that there are folks, I think, what was his name? Richard Blakesley was commenting. There are some data tools that are getting put in place so that you don't have to throw bodies at the data gathering process and the reporting process, moving in this direction of fewer bodies, more technology towards building these more diversified portfolios. So there's technology is a wonderful tool to replace the need for just basically throwing bodies at it and sort of the analog model of gathering just the data and the sourcing, the information, the monitoring of potential investments. There are tools that are, again, getting built, and that's just the evolution that thankfully is taking place. Yeah, this is for a half hour. This was a pretty good conversation.
Yeah, I also just wanted to chime in. I think families wanting to get into ventures, especially earlier stage, is also driving not necessarily there's a disruption within the industry, but I would say at a brief stint at a law firm where a lot of our clients were top VCs in Silicon Valley, a lot of the funds would have these institutional investors and they would consistently roll them over to the next fund. So even family capital couldn't get into any of these funds. Except, Sequoia, they'll charge you $330 and put you in a late stage growth, right? Where there's not much meat on the bone. But given the gravitational, pull of, I guess, early stage emerging manager funds, especially, I think it's helping drive that. But I would also like to comment on the conversation around diversification and concentration. Funds. One of them was solving for that by becoming the institutional LP in some of these huge funds and then allowing families to ride, sidecar. So I think that's an interesting slight disruption to the industry. And they don't charge an additional layer of fees per se. They sort of shave it off. Instead of a $330, Sequoia would charge for a direct fund, it would be $2.5 too. And then another fund I came across, it was actually a fund of funds. What they have that's really, really compelling is something that is a bit of a hack, as much as it allows for diversification in being the fund of funds where you get into a lot of emerging managers. Also have a proprietary that serves as an early, detection radar detection for coming outliers of portfolio companies before the emergers even. So what's interesting is on the one hand, at a 0-10 level, they're able to then, using their software to say, these are the ones that are doing really well. Then for co-investors, you're going to get that real pop, I think.
So that's basically what you did do at Greenspring, right?
Yeah.
And you around the question is what's the minimum to get into Greenspring or for that matter, Bell's Fund, Grosvenor?
Wait,
Yeah, I mean, it's, yes, there are certain commingled vehicles that are fund of funds, Greenspring. There's a Michigan focused one, Renaissance Ventures, which has performed very well. There's a,
okay. Actually,
yeah, I think things like that. Is it a $5 million minimum commitment? Is it 10?
Greenspring took investors as low as $50,000.
Okay.
Okay, cool. I have a quick question for the VCs and all of you. Anytime you encounter the question of, well, it's really, really difficult to change consumer behavior, what are your thoughts around that? Because on the one hand, disruptive tech itself is, kind of more or less defined by the fact that you do change behaviors. And years from now, you go, well, how did we ever live without that technology? But this is an initiative that comes up, and I'm just wondering how you go through that when deciding whether to get into a tech play.
I can chime in that if you like, as a VC, because that's a question that we encounter almost every day when we see a brand new technology. To us, that consumer behavior change is the most critical factor and is the reason why we pass on 90% of the deals that have great technology. But our criteria is if there is a major pain point that has depth, breadth, and frequency, then eventually consumer behavior will change. But if it's a nice to have feature, even if it's a great technology, then the risk of consumer behavior change is really, really strong. And I think it happens even in the B2B sector, the changing of the behavior of the purchasing managers, whether it's a hospital or a company or a factory, is really, really difficult. So I think, Andrea, you hit on a very important point for us that we consider every day.
Consumer behavior, it's a very silly but easy example is, the point was don't talk to strangers and don't get into other people's cars, right? And now with Uber, you get into a car with a stranger, right? And it's normal course of business. So consumer behavior changes if there are aspects that are beneficial to one's life.
Yeah, I always think in terms of systems and sort of processes and learning from others. And so I think in terms of the disruption cycle, and then the book, The Tipping Point, that talks about how does things tip over to change, that there was begrudging, very little movement, and then all of a sudden an accelerated movement. And so that's, for me, it's a case by case basis as to whether it's what the product is, whether it's a financial services product or just a basic food product or CPG product or consumer product. I don't know, other than I always like to study systems and then see where there's patterns to be learned from. It just varies. That's my read.
Other comments, questions?
Hey, Todd, it's Rob Colorina. Just one quick clarification there is, on the ride hailing versus taxi, there's two things. One, there's commercial upside. And then two, the whole system and filtering and the algorithms that basically go on ratings of drivers and passengers, that helps both screen and make comfort. So it's not necessarily an apples to apples comparison. Just thought to throw that out there.
Yeah. You can pick a lot. I just picked something that I thought was very obvious. You could say the same thing about consumer behavior. Nobody was wearing Fitbits, right? And now it's a huge thing. Things that are beneficial to you that you deem useful, behavior can change pretty rapidly.
Other comments? One question I have that we're going to have after this with Joe is, what do we want to do next? What does do look like in part 3 and 4? I'm not limiting it to 3, Joe. And what people want to see. If you could let us know, maybe we'll do a quick 3-question survey, get the input.
Yeah, I think we're getting down to some real, and Call, you asked some really relevant questions, is that this is a broad topic, right? And there's just a remarkable amount of people that aren't aware of some of the changes taking place. And so that's really was the goal of this one. And then just sort of some of the topical things that somewhat are aligned with some of the headlines as to why they need to change and the like. Getting down in the weeds on how to change it. If you study it, I always go back again, in my simplistic mind is modeled after what happened in the public markets. And it goes back to this issue of standardized reporting. Standardized reporting is transparency, broadly defined, is one of the structural optimizations of any system design. And it's what's lacking in the venture asset class, so that better capital deployment can take place and this research can be leveraged and applied. I also think in terms of scalability. This is about deploying capital at scale. In the public markets, there could be a hot hand on some niche asset class. They had a trading strategy and they'd have a hot hand for a while. And there's no doubt about that. There's always that opportunity set. But that doesn't mean that scalable or repeatable alpha that serious capital can be deployed to with confidence. It was just an episodic form of outperformance and oftentimes would drift off, either because a person got so successful, they made so much money themselves, they're no longer hungry. And we can think of the parallels there with very large venture funds versus the emerging managers that are scrappy and have a pretty good track record in aggregate. But it also comes down to the need for just thinking in terms of deploying capital at scale to deliver repeatable alpha. I always think in terms of like a manufacturing process. So we'll be talking in subsequent sessions about what does it take? What is the proper standardized reporting? What does that even mean and why is that important? And the implications of that at the fund structure level and obviously the architecture and the ongoing management. How can you source, which is a really important question. How can you source startups? And given the historical norm of being in network and having something referred into you, or as the VC, you have to go attend a whole lot of demo days and a whole lot of networking events to try and get in front of and maybe find some entrepreneurs that you might come across yourself. Well, just at a system design level, that's a process that is terribly labor intensive, highly variable in the outcomes, and not something to design a system around if you're trying to improve the system's outcomes. And so it comes down to the sourcing we'll discuss as well in a view, particularly at the seed to be. That's a really important comment, is that this research is largely about optimizing that seed to be round. After that, it very much, you have more linearity to the financials, you've got more data. It looks even more like a private equity transaction when it becomes later and later stage, because you've got more meat on the bone on their financial reports, and they're hopefully audited and GAAP compliant, et cetera, et cetera. So that's really, I think, the coming attractions. And then there are some models we'll actually show where this is starting to come together, where they're actually pulling together a lot of these individualized pieces. There's a variety of companies that are doing bits and pieces, but focusing on only one or two. But there are some models coming together that are incorporating all these tools to actually deploy capital at scale to deliver repeatable alpha, regardless of the venture thesis.
Joe, can you address the angle from Todd said, you need a big team to diversify, and I understand what you're saying, but can you address the part where each investment is a one-off standalone financial transaction? Once you've gotten past all the data you're talking about, how do you deal with that with many, many, many investments?
Well, it also comes down to, again, the portfolio architecture, and this is getting in a bit of the weeds on what the next ones will be, but it really does come down to taking a different approach, particularly if you're building that seed stage portfolio, right? It always comes back to, if we think in terms of a seed to be strategy where you're going to deploy across all three rounds, how do you assemble a seed stage portfolio that fits your venture thesis, blockchain or female entrepreneurs or geographic focus? You can define your venture thesis. And that is a choice between you and your LPs as to where you want to place bets in to get in front of the innovation based on that thesis. But beyond that, the process of then sourcing the companies to populate a seed portfolio, it comes back. The public markets, it's called smart beta. You define your factors that will exclude a company from making it into that seed stage portfolio. It's multi-factor filtering is what it's called in the public markets, where you're defining what you don't want. Because the more you spend time defining what you do want and get locked in on doing a transactional approach, then that scalability starts breaking down. And so it really comes back to a change in perspective to manage risk almost exclusively in filtering out the companies you don't want, making sure those that do make their way in, yes, they fit your venture thesis, but they also don't have the character traits that are highly probabilistic of them failing. Because that's easier to identify than trying to pick a winner early on, because picking a winner means you're predicting the future. But defining what you don't want is about analyzing the past and identifying those high risk character traits and behavior traits at the entrepreneurial level that are highly correlated with bad outcomes. And there's some really interesting work on that.
So one quick question, I guess, from Andrew.
Yeah, no, that part I understand makes perfect sense. And data and transparency, I'm saying when you get down to actually executing 40 transactions, let's just pick a number. Now you have 40 individual legal agreements with 40 companies that define your investment. And they're not unlike public companies. There's no consistency to how they're done. How do you deal with that?
Well, again, this is always about optimization, right? And it always comes back to some first principles of optimization is standardization. So standardized term sheets. Why is Y Combinator so successful is because they literally have their standardized safe, right? And investors have just adopted it, right? And it doesn't require a valuation negotiation or anything else. So there's a lot of lessons learned where standardized term sheets has become a norm for that this exact reason. So at least now we're not negotiating every transaction, every valuation, and haggling over every little component of an individualized term sheet. And that term sheet needs to be de-risked. Y Combinator's finally started incorporating QSBS in their legends on their template, because 1244 itself de-risks seed stage investing just through the tax code without any other due diligence required. And they're now incorporating that since I think about 2018. So it's standardization of de-risking. And again, standardized term sheet is just one easy step in that whole process. There's some other things that some of these models that are coming together is also the notion of capital calls is brain damage. If you've got a standardized term sheet and you're giving the same amount to every one of them, think of an index fund for your seed stage portfolio. Now all of a sudden you can do electronic release of the funds, have your investors to put capital in the bank account and just have the money electronically released. So you're not just doing capital calls every time a deal gets approved and a term sheet's up. This is just using technology to replace the bodies, because that old model has just never been broken down and built back up saying, okay, let's use modern technology to streamline the workflow of the back office of a venture fund. It's happening, but this is just taking a whiteboard and thinking, how can we fix where there's so many choke points in the very operations of the back office of a venture fund that ultimately leads to the need for concentration and overanalyzing a small number of transactions to get in the portfolio, because their own back office is just not automated. And that's true, lawyers, the service industries broadly defined were oftentimes the last ones to adopt computers back in the 80s and 90s.
Yeah, my question was disintermediating the lawyers, not the other part.
Yeah.
And against all of that, what changes and what doesn't change with AI? And, some of the things that you mentioned already, Joe, AI, certain things can be easily, I guess, ameliorated with that or standardized. But what wouldn't AI be able to, because even now looking at certain people's expression, sentiment, do you think that changes, that goes away? Or do you think we still need that human interaction to, and this is a question for all, but just, I'm curious what you think, what role you think AI plays in all of this.
This is my take. At the end of the day, it comes down to the entrepreneur and evaluating the qualities and the capabilities of the entrepreneur and the qualities and capabilities and behavioral dynamics of the team that they put together. I don't think that AI is going to be able to solve for that.
Yeah, this is Hamlet. Early stage investing. Every deck you look at looks identical. Here's what's broken. Here's what's missing. Here's the mousetrap. Here's the hockey stick, and here's a team that's going to execute it. AI is going to give you for that. I think it's a subjective human call. You need to have a manager who understands risk, but understands and can evaluate jockeys. Okay, does technology make sense? Does the TAM, the market, all that make sense? Great. Okay, is this the team that's going to execute? And is this the team that's going to stick together when the entire plan falls apart and you got to scramble?
Sure.
That I don't think humans are not going to be taken out of that loop anytime.
Sure, but like, how many times can we, look back and say, "Oh, turns out we were wrong," right? Because you think you have a good read on the jockey, but if AI could pick up on micro expressions, right, and be able to do something with that, I think that could actually play an interesting role in all of this, right? Because
I would argue humans made the decision to invest in FTX. So that I think is it's a flawed diligence process. So when you look at people who get early stage venture wrong, it's because they missed glaring things that I hadn't seen anything from an AI standpoint that can do what a proper manager with intuition and intelligence can.
Not yet. Also within the alternatives industry, there's so much manual process still that on a base level, Andrea, I think that what AI is going to be able to do is to automate that part of the process. And it's really going to be able to enable better decision making at the higher level. It won't replace it, but it's going to make it more insightful.
Great. Thanks.
Yeah. Another thing I would add, again, I tried to frame my perspective early on because I'm just a broken record about learning from the public markets. And Danny Kahneman, I'm just a huge fan of, followed him for a number of years. And he was the keynote speaker at the CFA Institute's global annual meeting in Beijing or Hong Kong back in 2018. And he did a presentation on this, and his comments were simply stated. And for those of you that don't know, Kahneman won the Nobel Prize in economics in 2002. Yeah, and he's the father of behavioral economics, the whole Moneyball notion, where data versus human bias. And he said his quote in his presentation was that, look, algorithms beat human bias all day long. That's not hard to understand. But simple algorithms beat complex ones. And that's where a lot of the quant mentality goes, oops, because the natural quant mentality is to build complex algorithms to be the secret sauce of their investment decision, whether it's public or private markets. Simple algorithms beat complex ones. And if you layer in Malcolm Gladwell's work in the book Blank, he finds 4 data points as the optimal number of data points in a simple algorithmic decision framework. But that has to be in the hands of an experienced practitioner. The human capital, the human component can never be overlooked. But it's a combination of those two. Simple algorithms, the right data points, and a simple algorithmic construct in the hands of an experienced practitioner. That is the optimal model.
Okay, so I'll say this. I love Malcolm Gladwell's work. In his book, he actually talks about how in 5 minutes, we know if we like someone or not. And more often than not, we've already decided if we like someone or not, and then we look for justifications later. I think it's very easy sometimes for founders to create, to create a curated message, right? Knowing what you want to hear. And that, I don't know. I think the human, we often get in our own way. And, there's a reason why we're emphasizing the diversity of thought, diversity of, just backgrounds to try to thwart that, right? Otherwise, we get into the same things we're comfortable with. So anyway, but yeah, no,
I think we need to optimize both. Mariana, go ahead.
Yes, hi, amazing panel. Mark, this is the best one so far, so well done. We are all, what Richard said, nodding all the time. So, and talking about Richard, I mentioned in my comment as well, Capital Pilot Boost has very innovative model in London. So they're using AI actually to remove lots of unconscious bias in the process. But again, I don't want to jump into Richard's mouth. So Richard, do you want to explain maybe that where both human AI actually interacted for the best outcome, where you don't really, let's say, remove from the process someone that maybe, underdog and can really deliver massive return later on, based on obviously your own assumptions because of your previous experiences, which is also going to Andrea's comment about psychology of our own.
Thanks, Mana. And I'm not here to pitch what we do, but I can talk about our experience, having made 100 investments in UK-based startups in 6 months using a model that is learning from exactly the way in which human VCs codify their investment decisions. And the really interesting outcome is that without any desire to create positive discrimination, the portfolio that we've created is extraordinarily diverse and diversified. Every sector, every geography in the UK, overrepresented in terms of female founders, overrepresented in terms of ethnic minority founders. And that's been achieved largely by creating a model and a system and a structure which is easy to access and which removes all of the biases which Joe was talking about. So it's been a pretty interesting process, pretty interesting experiment, and one that we're looking to scale up now.
Yeah, I think I really do believe, having followed this evolution of the venture industry for so long, is that I think we are, and I think this is a prediction, which is always dangerous, but I think we're much closer to the tipping point of the real structural changes in the model than certainly we've ever been. And there is certainly enough evidence that acceleration is happening. There's lots of experiments, lots of data vendors, lots of tools that are being built. We were even seeing a lot of activity from public market investors very quietly funding the infrastructure for secondary markets, a proper NASDAQ for private securities, and the corporate governance expectations or requirements as if they were a public company, but they're exchanges for private securities. So a lot of this infrastructure and toolkits and back office, broadly defined, tools, components, processes are taking shape. And I think that all of a sudden we're going to look up and see this tipping point got arrived at us all of a sudden. But in fact, a lot of that background work has been done now. I've been, like I said, tracking closely for the last 9 years. And I'd say in the last 3 years, it's accelerated.
Joe, we got one more question here from Harvey.
Hi, I just wanted to get a consensus from the group, the government. There's news articles that have been coming out about the SEC looking into the FTX disaster and so-called sophisticated VCs putting in all this money and their due diligence process and potentially opening up Pandora's box for LP lawsuits. Does anybody have a comment about that?
I saw that this morning, and I was going to reference it and add it to the deck for folks to grab. And yeah, it was in Dan Premark's Axios piece this morning. And I think some of the summation that he put in the article, I think, was pretty accurate. We don't necessarily need that, but I think it's an important shot across the bow. That's this is just personal, for LPs to feel more emboldened to hold accountable. If nothing else, the GPs have to, if they really screwed up, have to feel like there's some degree of personal accountability for just going along with the crowd, because they are fiduciaries afterwards. That is somebody else's money. And if they completely abandon it and leverage their social capital, leverage their all the wrong reasons, which gets repeated time and again, and just say, well, that's what happens. You've hired us to take great risk, as their rationalization is. There has to be some degree of more personal accountability, is my editorial comment. Mel, you're
yeah. No, I mean it's hard to, the SEC taking charge and litigating stupid, but yeah. It's it goes down to the investors. You've got to hold people accountable for good decisions and bad decisions. And so, how did this? I would love to say I'm not in any funds that were not in FTX. So, so we're having some hard conversations. Yeah.
The article did mention this at the economy that major institutional investors will never go after the GPs because they would be then knocked out of potential deals in the future, and that it would be more like the family office and the ultra high net worth or high net worth client that potentially could go file suits and things of that nature.
Historically, funds have done.
Yeah, I mean, that goes back to this notion of it being an access class. And thus, as an access class, they can use that as leverage to not hold themselves accountable. And that's a real fundamental reason why it needs to be more like an asset class than an access class. That's just a glaring example as to why.
Other questions?
Oh, well, I just think that that's going to change just a little bit, especially against the backdrop of Sequoia getting into FTX after a 20-minute conversation with Sam when he was still playing a video game, League of Legends. This one will probably go down in history, so this should be an interesting one. But yeah,
I hope it goes down in history. That's
it was extreme, but I saw the same behavior 20 some years ago in the late 90s. Again, from the belly of the beast, I saw the same behavior, different players, different companies.
There's an American comedian. I'm sure many of you know him. His name is Stephen Wright. And he comes up with these great two-liners. And he just reminded me of one. He said, I think I've got amnesia and deja vu at the same time. I think I've forgotten this before.
That's exactly right. Lovely comedian. Yeah. You're right. It is deja vu all over again. And again, having been on the inside of it and seen it again, it's just different players and different firms, but the behavior is the same. And the thing that I've watched over the last couple decades is, Israel from a standing start is just rocking it, funding real interesting tech, doing great as they're the number one most innovative country in the world, right? On a per capita and all the standardization and normalization metrics. Clearly, we've seen what's happened in China. They become a technological threat, as obviously, and other threats, as Steve talked about. We don't have another decade or two to learn the lessons with another crop of startups and another crop of investors again and repeat the same behavior. I think we've lost that luxury of time. I think the urgency to be better at this, get better information from startups. That should be an expectation. Demo day, because you're good at pitching and everybody's got matching t-shirts. A demo day shouldn't be the reason you get funding. Standardized reporting, some objective metrics, better investment processes, right? Better in risk management, better in the growing appetite for impact and ESG. I mean, those qualitative metrics and motivation.
Joe, I apologize, but standardized reporting does not help us about when the multiples shrink, and does not help us when the founders do something wrong. Standardized reporting is for follow-ups when you're already in the portfolio. So I don't think it is for every stage, and it is not for every stage of selection and every stage of management. So I don't think that that's the key to the whole situation. Maybe it is the key to the systematic portfolio creation as opposed to management of the situations, which by definition are binary, right? Either succeed or not. And that's what we're trying to solve for, not for just reporting. Sorry for this disagreement.
Well, thank you for that. And as I was starting to say, the second phase is better processes. And what you speak to is, yes, managing timing risk through better capital deployment decisions, more disciplined risk management in the capital deployment decisions, hopefully with an aspiration of better outcomes, right? Better information will lead to allow and support better investment processes and capital deployment and risk management practices, with a better outcome being, as Todd was pointing out, less dispersion around top and bottom quartiles. This becoming more like an asset class than an access class. So serious money that's on the sidelines and probably is thirsty to deploy capital outside the public markets. I mean, what are the public markets going to deliver in real nominal alpha over the next 10 to 20 years? A lot of work on that. Just mid-single digits is probably
Joe, I agree with you, but I think the main thing here is not reporting again. The main thing is corporate governance, because you can report whatever you want at the end of the day. And family offices don't have representation on most of these boards. And even funds cannot influence founders, because the founders normally have much more, many more votes. So as a result, the transparency is the weakest part of the reports. You cannot change their mind the founder's mind, even when they're going under with the phenomenal reporting.
Well, I will take exception to that. Anybody that invests in a startup with lacking any sort of control features, whether it's reporting, whether it's transparency, whether it's whatever, then this is the very risk, or part of the very risk structure that we're all talking about investing away from.
That's how you change a system, is changing expectations and behavior, both of entrepreneurs, but also those providing the capital to the entrepreneur.